What is happening, best ever listeners? This is Matt Faircloth, and welcome to the best ever CRE show and my segment called Next Level CRE. Thank you. If I don't say that enough on this show, thank you for listening to the best ever CRE show. Gratitude to you from all the other best ever hosts. Please like the show. We want your love. Like us and put the show into your subscription box so that you get a best ever show in your box every day. Because that's how long this show's been out there, forever and ever and ever, daily show. Put it out there so you guys can learn about real estate investing, commercial real estate, all cool stuff on a daily basis. So that's what we got for you. Put the show in your subscriptions because we want to talk to you daily, right? Quick tip from the Best Ever Toolbox here. If you guys want to reach into that with me, I got a tool for you that Best Ever can help you guys get to the next level for your business. Go to bestevercre.com and join our community. You know why? It's free. There's hundreds and thousands and bajillions, actually just hundreds of other real estate investors out there that are building their business just like you are. You can't do this thing by yourself. So get into the Best Ever community to meet other real estate investors that are out there building their businesses as you are, because you can network with them, hear what they're doing, hear how they're doing it. So get into the Best Ever community and make a post, introduce yourself, ask some questions. There's lots of people out there that are thriving in their businesses, and you could thrive alongside them. Speaking of thriving, today's conversation is with my new friend, Ben Fraser. We had a great conversation. What I liked about today's conversation is about the changing world about financials, the changing world of financial planning, the changing world of what it is to be true wealthy, right? And also, even though you might not want to be a billionaire, right? It's important to think like a billionaire and invest like a billionaire. And that's the name of Ben's podcast. For his show, you guys should check out as well. So we're going to bring Ben on, but I want you guys to also consider the idea of sharing this show with people that are in your network that you want to consider investing with you. They're asking you about real estate investing and asking you about another way to build their financial wealth. Because today's show is all about other ways to build your wealth, other ways to become financially free. So consider that and share it to people that are in your life that are curious about another way. Maybe not just stocks, maybe not just Wall Street, maybe not just 401ks. There are other ways to do it. And today's show unpacks all that. So let's hop in. Best ever listeners, my guest for the Best Ever CRE show today is Ben Fraser. Ben is the Chief Investment Officer of Aspen Funds, which is, guys, 5,000 Inc. company, right? You know, you've heard they're a on the list you've heard of, 5,000 Inc. operations company, high level organization. He's responsible for sourcing, vetting, capital formation for his investments. Mr. Fraser's prior to your experience as a commercial banker, underwriter, we're going to go and talk about how a banker turns into a real estate investor. That's, I'm sure, a good story there, right? He drank the Kool-Aid and got on the other side of the table, right? He's worked as a boutique asset manager as well. Ben is a contributor on the Forbes Finance Council as well. And he's also the co-host of the Invest Like a Billionaire podcast with a pending book, Invest Like a Billionaire, coming down the pipeline. We're going to give you guys early access to that book, so stay tuned for that. Ben, welcome to the Best Ever CRE show.
Matt, thanks, man. Looking forward to it.
Yeah, thanks, man. Listen, let's just jump right in, man. Billionaire versus millionaire, right? Like, how do billionaires invest different? Like, well, what is the mindset of billionaire that's different than millionaires that you've seen in your research and studies and podcasts?
Yeah, well, there's a few things, and you mentioned the book, so thanks for giving us a shout out there. It's coming out in September, and we actually have a whole chapter dedicated to the billionaire mindset. And there is a very distinct difference in how billionaires invest and how they think about investing than millionaires, right? And a couple of decades ago, being a millionaire, was the end goal, but now it's feeling like, hey, a couple million, it might not be enough to live the lifestyle I want to live. And so
with inflation, brother, millionaire might just be survival. That might be middle income.
That might be middle income. And that's for real. And some of the biggest differences that we've found through our research as we started, putting together this book was, first and foremost, billionaires are investing significant amounts of their portfolio outside of the public markets, right? And so for your listeners who are investing in real estate, they're already ahead of the curve a little bit, right? Because it's obviously an alternative asset class. But what we saw is, pretty much any data source you can find from the pensions, the endowments of, the Ivy League schools, big family offices, they're all investing anywhere from 40 to 60% of their portfolios outside of public markets. The problem is the average retail investor is investing less than 5% outside of the public markets. Well, what's the big deal? Why is that, bad? Well, the reason private markets are attractive, and real estate is included in that, but that also includes private equity, buying businesses. It includes hedge funds. It includes venture capital. And these asset classes historically, based on any data source you could find, have generally outperformed the public markets from a return standpoint, and significantly outperformed from a volatility. I mean, much, much less volatility. And that's another big part of compounding and growth, is avoiding volatility. So those are the kind of the simple things from an allocation standpoint. The other thing that we've found too is from a mindset standpoint, is what we call an income statement mindset versus a balance sheet mindset. The income statement mindset is what most people are operating under, where I am, trying to build skills to go earn more income in my W-2 and my corporate role. And I can, get incrementally more income over time and use that to save for retirement and hopefully have enough to live off of. The challenge with that is lifestyle creep happens, right? As your income rises, so do your expenses. And that's a very hard thing to avoid. Myself, I have 5 kids. I've kind of given up.
You would talk about expense creep, right?
Yeah. I've kind of given up on managing my expenses. I'm just focused on getting as much income as I can now. And so it creates this connection of, to earn more, I have to work harder. I have to put in more time. I have to put in more hours to earn more dollars. So there's a direct correlation, which is kind of the opposite of what people want. And then, separately, you're generally paying a lot in taxes. The higher income that you grow, the more taxes you're going to be paying as a percentage of that income. And so you're never really tapping into the power of compounding. Compounding is the 8th wonder of the world, right? That's what Albert Einstein said. And those who understand how to harness it are the ones that win. So the other kind of mindset, we call it the balance sheet mindset. This is what billionaires use when they're approaching their investing, when they're approaching their net worth and the growth of their wealth. They're not focused just on growing the income. They're focused on growing their assets, growing the net worth. Because what they understand is, as you tap into that, the power of compounding over time, the ability for your assets to out-earn your own ability to earn, on the skills and the time that you put in, starts to significantly outpace the growth of the earnings you can make in your W-2, right? So as you get to a certain level of assets and the income and the returns that are generated from that, all of a sudden that creates this kind of escape velocity of your ability to grow your net worth without requiring more of your time. The other cool thing about it is you can use debt smartly, to not have to pay taxes or pay less taxes. There's a lot of tax loopholes, as you know well, with being real estate, that you can pay less taxes. There's a lot of people that read the headlines are always mad that these billionaires are never paying much in taxes, but they don't understand that the same loopholes, legal loopholes that these billionaires are using, are available for anybody. It's just knowing the rules, right? And then you tap into the power of compounding as you grow the balance sheet, the assets, the net worth. So those are some of the biggest differences. We have a lot more in the book, but those are some of the highlights that come to mind.
I love that. There's a few things I want to unpack there, right? And so the millionaire mindset that I'm very familiar with is very dependent upon financial planners. And I'll just throw a few of my financial planner friends under the bus right now, right? Not personally, whatever. And hey, there's some great ones out there, but the ones that I prefer are RIAs, those that are compensated through your net worth growth versus those that are compensated for selling you into funds that they make a lot of back end fees on, right? And I cannot tell you how many equity investors that I have had approach our company, DeRosa Group, that have had their financial planner talk them out of investing with DeRosa because it's not a security sold on the stock exchange, meaning they can't make a commission on it, right? Let's just say what the problem really is. So they will say things like, well, that's risky, or, that investment, that passive investment, that private placement in a business or private placement in something that's an alternative, right? Or buying a laundromat, whatever it may be, anything. That's risky. And that's also something they say, well, that's for the very wealthy. That's for people that are above a certain. Here's the thing, chicken and the egg, right? You could aside, like live like a millionaire, live like do that and do a lot of income-based investing, right? And then hope that, okay, one day maybe my net worth will become big enough that I can invest like a billionaire. Or you could note the true secret, which is in your book and on your podcast, that the way you become of that financial level is by investing the way that they do now. So I'm talking to the best ever listener that's not a billionaire, and I get it. Most people are not going to achieve billionaire status, but you will certainly grow your wealth if you do what billionaires do, right?
Yeah.
And that's by investing based on balance sheet versus income statement. I love that. What is your, again, I'll get you to throw some financial planners under the bus. What are some of the misunderstandings on wealth growth that you've seen, if you want to unpack that a little bit further with regards to everything from 401ks, stock investing, all that stuff?
Yeah, well, it sounds like you've actually read the book, so we're on the same page. We have a whole chapter on the truth about financial advisors,
let's do it. Oh man, you're gonna make some real friends with that book.
I know. It was. We tried to tone
a lot
of
people up on social media, by the way. I don't know if you have. Have you had financial planners? I have former friends that are financial planners because I put some shit out on social media, and they're like, "Oh, I guess I can't." Because I was like, "What's the stock market going to do tomorrow?" And what I'll tell you what's going to happen tomorrow. My tenants will likely pay, and if they don't pay, I have recourse. If Microsoft goes to zero tomorrow, what recourse do you have? And my financial planner friends did not like that too much.
Yeah, no, it's hard because it's felt like there's becoming more polarized. You're on this side or that side as alternatives are becoming more popularized. Because what financial planners can't ignore is that more and more of their clients are asking about real estate. They're asking about alternative investments. They're asking about private equity. And with the Jobs Act, as like these regulations are fundamentally changing access for the retail investor. But there's this massive resistance from the financial planning community at large. And I agree with you. There are some good ones out there. We know a couple of them, and they can be helpful in certain things. But when it comes to investing, they're really taught one way. Right? I went to school. I got a finance degree. I learned modern portfolio theory. I learned, the system.
Yeah, man, you're on that side. You drank the Kool-Aid and came over to the dark side, so to speak.
I did.
Really, it's the other way around, I think. But yeah,
I agree. I mean, I interned with one of the top wealth advisors in the Midwest. Was planning on becoming that, and thankfully didn't go down that path because I know I would not have liked it. Know what I know now, but what I really,
your soul slowly oozing out your ear every day, right?
Yeah, and it's just they get so sucked into this is the only path, and so anything outside of that is risky, right? And what I've learned is the word risk, if it's risky, quote unquote, they use that as a scapegoat to just avoid having to talk about it any further, right? Because it's an easy word to throw at something to avoid it. But from my background, in banking and underwriting and understanding how to, one, identify risk and manage around risk is not one thing. You have to define what it is, and then you have to define what's the likelihood of that happening, and then how do you mitigate that, right? There's always risk in everything you do in investing. There's risk in the public markets. So you made a great point. Microsoft could go to zero. That absolutely could happen. But most people don't think that, right?
Because what recourse do you have? Yeah, I tell you what, you'd have to get in line to come take the CEO's house. You have no collateral at all. If that equity investment you have goes to absolute zero, ask an investor in WorldCom, ask an investor with Bernie Madoff, ask an investor with a lot of those other equity investments that were viewed to be tried and true stock market based investments. Ask me what happens if those things go to zero. I can tell you real estate, yes, it can go up and down. Yes, it's not guaranteed. We don't use the G word. You and I don't, and everything like that. But you certainly have recourse. You've got collateral. If you're investing in liens, as we do at DeRosa, you've got liens on the property. Unfortunately, I could come take those things if I had to. Don't want to, but I could,
Yeah.
So.
No, you're exactly right. And I think, honestly, if I'm given the benefit of the doubt, which I generally will like to do, I think most financial planners are just ignorant, right? They don't understand it because they haven't been taught it, and they just avoid it because that's all they know to do. The other thing is,
you're being way nicer than I have been. That's
yeah,
probably why I lost some friends. But hey,
I'm trying to keep some of my friends, but I think you made another big point too of like the platform versus on platform versus off platform. Most financial advisors, their primary goal is to accumulate as much assets as they can on their platform, and they charge a small fee on that, right? If they're a flat fee RIA, they make more money the more assets they have. Well, it actually creates a conflict of interest, if you think about it, for them to advise a client to invest in one of your investments or invest in one of my funds, because the money is leaving their platform that they can charge fees on to come to us, and they can't charge fees on it anymore legally because they're a broker-dealer.
Now you're going where I've gone, man. At the end of the day, and listen, people are feeding their families doing that. And they would tell you, I'm feeding my family for helping people build their wealth. Yeah, to a degree. But because you can only offer, you can only sell your clients 2 or 3 different flavors of ice cream when truly there are 1,000 flavors of ice cream, right? When you can only sell those 2 or 3 flavors, and I'm calling every stock, equity, and bond investment, like let's say stocks is one flavor of ice cream, right? Don't be telling me that one flavor is Chrysler stock and the other flavor is Ford stock. No, it's just paper, it's stock-based equity, right? And then bonds. Maybe those are some things. Maybe REITs. You want to get a little cute? How about some REITs? But at the end of the day, there's a lot more ice cream out there. And I agree. Let's go to the point about the world changing, right? And I want to lead you to a real crux that I think that could happen in our society in our lifetime, right? The world is moving, as you said, away from Wall Street being the only way, right?
Yeah.
And the fact of the matter is, because the media somehow tried to fight it, but it couldn't fight off crypto enough, right? So now crypto's become a thing, thanks to social media, thanks to some other podcasts that are out there, and people that are seeing others make a lot of money in crypto for all the reasons, right? Now, your financial planner, up until recently, couldn't make money selling you with crypto, but I guess they got their lobbyists together and whatnot. So now, magic fairy dust, poof, there are funds that are crypto based, right? It's freaking diluted and everything like that because they got to have their own fees in there and everything like that as well. But crypto, I think, is the first example of the beginning of conversations of off Wall Street conversations of the masses being able to invest in things. What are your thoughts on that? Are you a crypto guy or no?
I'm a believer in that crypto is here to stay.
Yeah.
I think utility is still, the jury's out for me on a lot of these coins. I don't really know what utility is. Bitcoin, I think, has the most likelihood to become institutionalized, and we're already seeing that. To your point, and at the end of the day, it's here to stay, and it can't be stamped out. I think that's what's really interesting about what's kind of changed. And I think there's also some negatives too, where all these young high school and college kids have seen their friends get lucky and become million.
Yeah, Bitcoin bros. Yeah.
The coin pros, and that's basically casino investing. It's not real investing. So
that's a whole. But you're right. The crypto has the casino of that. You might as well just go put it on craps, put it on the roulette wheel, guys, if you really want to make that kind of whatever, not for nothing. There's a lot of people out there that got lucky. They got into Bitcoin when it was selling for $2,000, right? And hey, God bless them. God bless them. But they don't walk on water, right? So there's the bros, right? That's those. Then there's the people that are investing in crypto because they think that the entire world is about to collapse, and they think that for some reason that crypto will save, even though if the world really falls apart, that means that you and I don't get computers, and that's where our crypto is. So if we all go back to living in the Stone Age, show me how you get access to your crypto.
Right. Exactly.
Right. So, right. But at the end of the day, hey, maybe that's why. I think that your point is best, pragmatic. For whatever the reason why crypto is here, it is here to stay. And as a investment strategy, you want to learn how to play it right, play it. And your financial planner will probably try and talk you out of it unless it involves them selling you a mutual fund. that goes along with crypto, right?
No, and I'm a believer of having some holdings in crypto. I just don't think it should be a core holding, right? It shouldn't be, it shouldn't be, 30, 40% of your portfolio. And I've seen people do that. And I think you're taking too much of a risk, but
I've seen people with more. I had a buddy, I tried to talk him out of it. He put a HELOC on his house to buy crypto. You would talk about Looney Tunes, right?
Yeah, that's getting a little out there.
Right. Best ever listen. The views, I should just put it out there. The views and opinions of Ben and Matt are not the views and opinions of anybody. So please don't do that. But do you think that crypto is the signaling that the world is moving away from stocks? Like, that's good. Let's bring it back to that.
Yeah, I think crypto is a great leading indicator of that. I honestly think, if you look at, we have all these charts in the book, but of the growth of private alternative assets by AUM, it's growing right now at about a 15% compounded annual growth rate right now, and has for the past several decades. It's a freight train that is picking up speed, and Wall Street can't ignore it anymore. I've been seeing headlines of a lot of the big money managers, Blackstones of the world, coming out and saying they're offering funds to retail investors that are going after private alternative assets, because they recognize, hey, the retail investors want that, right? The podcast community, the folks who've been preaching this for a long time, they started to see what's happened with these alternative assets and with these billionaires' portfolios over the past several decades, and they want in on it. And I think that is absolutely going to create a massive tidal shift of investing. And because of the access that's being democratized, if you're an accredited investor, you can invest in any of these things, right? And so I do agree, where I still think early innings of a massive shift toward private markets, although private markets have been around for, many, many, many decades. The
arguably
democratization
since the SEC, since the SEC was a thing, So let me tell you, I just have it fresh in my head, Ben, because I just now, like 2 hours ago, interviewed Cameron Herold for this show. And by the way, best ever listeners, after you're done listening to me and Ben talk all the way to the end, go listen to the Cameron Herold episode. Wow. Let me tell you, Cameron was the COO of 1-800-GOT-JUNK when they almost went bankrupt. He got in and helped build it to, gargantuan size, right? And one of the ways that he did it, Ben, and it makes me think of this conversation, right? The way he did it was, back then, like junk removal. Let's say you got some trash in your garage or some stuff in your basement, or you're a flipper, like, real estate investor like you and me are, and you want to vacate a tenant's apartment that they were kind enough to leave you a bunch of trash behind. You buy a fix and flip that was owned by a hoarder, and you need to make all these things go away very quickly, right? Back in the day, just two dudes in a truck, that's just what you could get a hold of, right? You would just find a contractor that knew the two dudes in a trucks of the world, right? They could go move things. There was no SIC code. There was no listing in the phone book for junk removal. It wasn't a thing, right? So 1-800-GOT-JUNK, Cameron was the guy that realized this and said, there's no commoditization. There's no SIC code or no place for what we do, right? It's just a whole big smattering, a big spectrum of different small operators. So what they did, they petitioned the white pages back then. This is a long time ago. They petitioned white pages. They petitioned the coding organizations in the U.S. to make an SIC code for what they are, right? For that, and so they created the homogenization of that industry, and that's how they grew like wildfire. And before the organizations like like Waste Management or whatever caught on to what they were doing, they were off to the races. They were too far down the road. Right. So here is my long way. There is a question there, Ben. Here we go. Here's my question. I see what you and I do to be and I asked this to Cameron. He and I got into a deep dive discussion, but I want to get to a little bit of a discussion with you on this too, right? And you and I are way better than two guys in a truck, but
of course
we are a similar industry, right? We are very segmented as a population, right? And as alternative investment offerings, right? Now, what is the the pivot point. Now I get you and I can't go calling the white pages anymore or the yellow pages because they're done, right? That's just called Google now, right? And they probably would not take mine or your phone calls if we called up Google and said, hey, can you, but what is the assembly moment for real estate investing, for alternative asset moments, for us to truly invest like billionaires, right? There's got to be an assembly moment for all of two guys in a truck, in essence, you and me as operators operating in a little silo. If there were a unified effort for the world, the other 90% of the population that's not lucky enough to listen to the Best Ever CRE show,
right,
and to listen to your podcast, right? There's a whole world out there that have their IRAs in different things. 96% of IRAs, as you know, are invested in Wall Street. 4% of IRAs are invested in anything else, right? How do we make that 50-50? What is the moment that has to happen? Your thoughts. Again, you can say, I don't know, but I'm just riffing with you as a fellow operator and for the Best Ever listener to hear what we have to say about that. Your thoughts.
No, I think it's a great question. It's a fun thought experiment because you're exactly right to correlate, some of these big title shifts that we look backwards on and we just accept as that's the way things are now. But if you rewind the clock, it wasn't always that way. I even think about with Wall Street, right?
Yeah.
Wall Street is ubiquitous. 401ks are ubiquitous. Mutual funds are ubiquitous. There's so much capital inflows going into these products. You just assume it's always been that way, right? But if you rewind the clock to, 50, 60 years ago, when a lot of these things were just starting, it wasn't that way, right? Yeah. There was a lot of more investment in Main Street, but it's created this whole ecosystem where, hey, we have 401k plans that are company match. It's all just part of it. Just comes out of your paycheck. You don't even see it. It goes into these, predefined funds that you can't touch till you're, 62. And we have CNBC and all these TV shows that are just regurgitating the same information.
Oh, yeah.
And then we have these massive behemoth companies like Fidelity, like Charles Schwab, that are just these, 800-pound gorillas that are just doing, one thing with the public markets. It's created this whole ecosystem that has snowballed into this massive, part of the financial system that's all saying one thing. And it feels like, oh, that's just what the only option is. But I don't know what that tipping point will be, right? That's fun for debate and fun to think about in the future.
Yeah, it's all fun.
But I do think it's going to be more of a pull, than a push. I think the fact that the retail investors are becoming aware, right? And that's the whole reason for our podcast, for the book, for what you're doing. Like, we want people to be educated about what's available to them because it's available right now. They don't even know it.
Yeah.
And I think the more people that become aware of it, it creates this snowball effect, right? Where it just keeps growing and growing and growing until eventually you can't ignore it. And the whole system has to make a massive shift, in a very quick moment. But there's a big build that happens ahead of time. I don't know where we're at in that process. I think we're still early innings, like I said, because there is such a big ecosystem that you have to go up against with the Wall Street machine. But the people are unsatisfied with it, right? They're unsatisfied with their financial planners, and they're unsatisfied that, their portfolio goes down and the financial advisors still make money and they have to deplete their principal to retire. It's like all these things they're starting to hear, from these different educational resources that it doesn't have to be that way. And I think the bigger that movement becomes, the more it can't be ignored.
Yeah. The Wall Street machine does not want us in their sandbox, bro. They don't. No. They didn't want crypto in their sandbox. They tried their best to make crypto look like the biggest tulips, like you heard of the tulips thing from the 1800s. Oh, yeah. You heard of that?
Yeah.
Yeah. Guys, Best Ever listeners, Google, I think it was in the 1800s or 1700s. People tried to correlate that investing. People were investing in tulips. And there's this whole big thing, I think in Holland, and it's a very interesting study on economic psychology, right? So read up, Best Ever listeners. You guys want to study a little bit of history, read up on the tulip phenomenon. And people tried to call crypto tulips, that, investing in nothing or whatever. You're just, Warren, but people, the financial planners love to quote Warren Buffett. I wouldn't take all the crypto in the world for $1, and I don't think he would say that anymore. I ask him for a quote today on crypto. But So the world is changing. You're right. Maybe we're in the early innings, and maybe it's going to take more and more podcasts for people like you and me to talk to audiences about another way. I cannot tell you, even in my rising career as a capital raiser and syndicator, Ben, how many investors I've had to talk to about you can put your retirement account into real estate, your IRA.
Yep.
And I cannot tell me how many of those that said, is this legal? My financial planner tells me it's illegal. Illegal. That's what they told the financial planners, just those sons of guns told their clients that it is illegal to put their retirement account into something else, so that there's a big push, and there's also a $1 trillion industry that you and I are pushing a rock up a hill against,
Yes. Yeah. I mean, it's the smartest thing they ever did was to get all this money locked up in these 401ks that can, in most retail investors' mind, can only buy one thing, which is mutual funds or stocks and bonds. And it's created all this capital just sitting there, sitting idle, right? And so you're exactly right. I think as people get educated, they're going to be demanding different answers, right? Because I mean, we actually have over 60 charts in this book that show mathematically why alternative investing is the better approach, right? To have a significant allocation to it. And if you see the charts, like JP Morgan's putting out charts, BlackRock, they're showing that if you add alternatives, if you add real estate, if you add private markets to your portfolio, in every single instance, over whatever time period, whatever data set you look at, you're reducing your risk and you're increasing your return. Reducing risk, increasing return. Who doesn't want that? Everyone wants that, right? And that's, I think, what's ultimately going to drive this big shift is people demand something better,
something new, right?
Yeah,
I think all it takes is the stock market to take if it takes a major sneeze, which is due, and but I've been saying the stock market's due for the last probably 10 years, but hey, so who knows? Maybe it won't. Who knows? But anyway, moving on to I want to just touch your analogy real quick on income statements versus balance sheets, because that was part of of something you said at the beginning that I want to just unpack a little bit more on the idea of investing for balance sheet versus financial income statement. Maybe like I'm going to make an investment and I will put a nickel in to the machine and it will spit out 2 nickels versus buying the machine itself as the asset, right? Maybe that's you can have that analogy, by the way. So
I like it. That's a good one.
Yeah. So
nickel
can
machine.
You go there lean in there a little bit more on some specific examples?
Yeah, absolutely. I think one of the seminal books that was written a long time ago is Rich Dad Poor Dad, right? And a lot of your listeners are probably familiar with that book. And he talks about these concepts that a lot of people, I think, struggle to grasp. But if we're using big words, income statement, balance sheet, if you're not an accountant, if you're not in financial statements, you might not understand what that means, right? So to break it down a little bit, so an income statement is simply, what's the money that comes in minus what's the money that goes out, and what are you left with at the end of that month or that year. And a balance sheet is what do you own and how do you own it, right? Do you own it with debt, with equity or combination? And what do you own and what does that asset produce, right? So it's important to identify what assets are, because a real asset, a good asset, is one that produces returns on its own. Real estate is a great example. You go buy a multifamily apartment building, you get tenants that are paying you, that cash flow goes into your pocket and can build up, and you can leverage that into buying more assets. And the idea here is creating a disassociation from your wealth growth, your wealth building growth rate from your time, and making your money work harder than you are, right? That's the ultimate dream, right? It's not to have to work till I'm 70 years old and hope to God that when I retire, I have enough in my 401k that I can live off of till I die. And hey, by the way, average lifespans are going up pretty significantly, pretty rapidly. I think the model is already broken, and I think it's going to become even more broken, right? Because not to get on a little bit of a side, but when the 401k was created and these rules were instituted, the average lifespan, I forget the exact number, it was under 70. So you think about at that point, the goal was you get to 62 and a half, and you can start taking retirement, and the average lifespan would only use those funds for another 5 to 8 years.
That's all it was designed for.
That's what it was designed for.
That's it.
And now you're having to go to for 20 years, 30 years, maybe even beyond that if we see some medical breakthroughs in lifespan. And the model is broken. So you need assets that produce cash flow that don't require you to pull out your principal, to pull out the value of the asset to live off of, right? But to live off of the cash flow being generated, and then leverage that cash flow into buying more assets that produce more cash flow. And it creates this positive snowball trend that is making your money work harder than you're working for it.
Yeah. Have you read anything by Garrett Gunderson?
I know Garrett. Yeah, I know his
I heard,
ideas.
Yeah, I heard him speak on a GoBundance stage many years ago. And that again, he got to me too late. I'd already drank the Kool-Aid, but it just validated a lot of what you just said. And that, so best ever listeners, check out the author, Garrett Gunderson. It's making me realize I'll probably try and get him on the show at some point. But what he's talking about is the old model versus the new model, which Ben had just highlighted, right? Like, why not invest now? For things and create that cash flow so you can enjoy the lifestyle now, because life's short, right? I want that cash flow now. The whole thing about keeping my money freaking locked up in a lockbox that I can't touch until at the earliest 59 and a half. In that, but this whole thing is just antiquated, right? Why not invest now? Enjoy the cash flow now and build my lifestyle now. And that cash flow stays with me when I'm 50, 60, 70, 80. Maybe if all this longevity, stuff and all the NMN and vitamins people are taking really takes in, and you and I get to live to be longer, right? Maybe it keeps going into the 90s, 100s or forward, right? As we figure out how to make humans live longer. Think about that, Ben. If we can figure out how to make humans live longer and really enjoy our health and fight off all these, the things that can kill humans early, right? If that's the case, the concept of a retirement account, an IRA, goes away, right? What's the point of even having that? Because what if 70 is middle age?
Right. Yeah. And it sounds kind of crazy to say, but I don't think it's that crazy. I don't think it's that crazy.
Yeah, it's not. Things are moving fast.
Very fast.
There's the whole inner age thing. You ever do that? Have you done the inner age thing where they take it's like a blood test you can get?
Biological age or whatever.
Yeah. Right,
I haven't yet. Yeah. I'm very interested in it. I'm kind of at that point where I need to start doing some of that.
It's
for sure.
Interesting, and again, we're just a lot of things are in the first inning, right?
Yes.
As you said, financial, the whole changes in the finance world and the longevity world is all in the first inning or whatever. We're starting to figure some things out, and there's becoming tests where we can determine what your true biological inner age is versus what your exterior age is, right? Your chronological age is the way to call it, right? So these things are all related though, because if I'm truly aware of my body and how long it's going to make it on this earth, I'm going to want to make financial plans like a billionaire would, to enjoy the revenue that I'm making, whether I want to work or not, so yeah.
And if we've got more time, then
we got all the time you want, brother.
Power of compounding. Yeah. Well, yeah, I'm saying if we were going to live longer, the power of compounding becomes even more valuable.
Yes.
Right? Because compounding's magic is in the length of time that you are compounding, right? It's, if I can double a penny every single day, all of a sudden, and just if I add an extra day, by the end of 30. Have you
seen that? I saw that on Facebook.
So crazy.
I put that out there. If you take a penny and double it daily, it turns into, it's like trillions of dollars. It turns into pretty quickly,
very quickly. And that's the idea, right? Where you're compounding your wealth, and you don't have to do anything for it. It's doing it by itself. It's achieved financial escape velocity, if you want to call it that, right? Where it's the amount of cash flow and growth that your assets are earning far outpaces what you can spend. And it creates this massive compounding.
Yeah. Do you think the concept with the devolution and 401ks kind of becoming less relevant and whatnot, does the concept of retirement become null and void, or is like, well, do we get to a world like, you can retire when you're 80 or 90 or whatever, or does the concept of retirement go away altogether? Because we're in a world where you and I are now working on Zoom. We're still contributing to society, but maybe not in a physical office place or whatever. Do you see the world evolving to a point where it's just we work, we make money, we invest, we live off of some of those investments, and we just grow financially and do different things as we evolve as people? What do you think about that?
Yeah, I think that's another fascinating thought experiment to play out, because in tandem with that question is, I think, how does AI impact?
Oh, here we go.
Where are we going? What does work look like 20, 30 years from now?
Man.
I've just started seeing some of the early thing, like just the early innings of AI, right? We're starting using our business in different ways and just testing it out and trying different things. And it is mind-boggling what it can do already right now. And it's only going to grow. And so I think, I'm in the millennial generation, for better or for worse. And what I've seen a lot of my peers and probably more younger, I'm on the tail end of it, is the idea of FIRE and financial independence, retire early. And the idea of the idea of traditional retirement where I don't ever work anymore, I go sit on the beach and sip mojitos and play golf. That's not that attractive as maybe it used to be, right? Just do that for the last 5 years of my life while I'm old and frail and my body hurts. And
it sounds like that sucks, Ben.
Honestly, sounds terrible.
I've talked to a lot of, I know a good amount of retired people. None of them that I know are happy. Not one. They're fucking miserable. They all think back to what life was. They'll tell you lots of stories of when they were relevant,
Yes.
Like, hey man, back in the day when I used to, and I mean, and these were really people that did really, really good, valid things. School teachers, business owners, those kinds of folks. They're like, man, I'm going to get my gold watch. I'm going to retire. And just people want purpose. They want to live into a thing.
100%.
Yeah. And I've even met people that have done that FIRE movement thing. And the only ones that I know that are happy are those that are doing like deep adventure stuff, like the van life and all that kind of crazy stuff,
Yeah.
But even the van life thing gets old.
That gets old after a while, right?
You can't live in a van forever, man. Don't be talking. They can't do that. That's cool to do when you're 32. But show me people that are. There's only a handful of people doing that into their 10, for a decade or whatever.
I tried the RV thing during COVID with my 4 kids at that point, and I was like, this isn't for me.
Me and my wife did it for one weekend. My wife was like, I feel like I'm home, but it's less convenient.
Everything's a little smaller. Bed's not comfortable.
It's like a smaller, less convenient version of my house, right? And it's hot. It's not comfortable. The bed sucks. The air conditioning's not as good as I'd like for it to be. And I'm like, okay, let me direct this thing back to our home so we can be where we're more comfortable. So
But to your question on, does it change? I think yes. I think the bigger goal as I see it and feel it from my peers and what I see is people want purpose. They want to enjoy what they're doing and they want to have financial freedom, whatever that means. But most of the time I want to have some level of control over my time, what I spend my time doing. And maybe when I'm 70, 80, I don't work 40, 60 hours a week, but maybe I'm working 20 hours. Maybe I'm still involved in something and I have purpose, right? And I have excitement about what I'm doing there. And that's what excites me is the idea of, I love what I'm doing. I'm working really hard right now. And at some point I want to slow down, but I love it. I get up every morning and can't wait. It's just
I love to do
fun.
what I do too. And then I think that's what it is. What is your definition of financial freedom?
I think having
you kind of just said it in essence, but I wanted you to put it in like a sentence or two in that for the listeners, because it used to be to play golf and drink martinis every day. I'll do that for a day or two, but then that would also suck, right? So, what is your definition of financial freedom?
I think from a pure math standpoint, it's having enough passive income that covers my expenses to allow me the optionality of working or not. But the other part of it that I think is the real part of it is having control over what I get to spend my time on and what I want to put my passion into, right? Because we do have a short time on this earth. We have one life. We got to live it well, and I want to go all out, right? I want to give everything I got, and I want to do things I enjoy doing. And so being able to have that control over what I spend my time is I think the best definition.
I think you nailed it, man. I would agree with you. I would think that financial freedom to me is complete ownership of my time. The end, right?
Yep.
And that's what, if you're going to invest like a billionaire, right? that is what our end game is. We're evolving towards is being able to own my time in completeness. If I want to take my family to Paris for a month, I can. If I want to go and write a book or be a contributing member to society, because you got to understand happiness is not doing nothing. Happiness is doing what you want to do, right?
100%.
Yeah. And financial freedom is just freeing up my time so that I can do what I want to do, right?
Yeah.
All right. So I want to completely I want to talk about your company, Aspen Funds, a little bit, changing it up, right? You're, again, banking, underwriting, training, like I said, financial, like evolving up to be a wealth manager, that whole thing. At some point, did you have like an aha moment like, oh, wait a minute, this is selling my soul slowly, right? What was your moment that made you get into the entrepreneur pond, so to speak?
Yeah, I didn't have a very traditional path. I think, I'm one of the anomalies that actually loved school, did very well in school, loved just learning, and got a master's. And the next logical step was to go and corporate, right? And so I did that for a little bit, and thankfully ended up in banking, commercial banking, and it was very eye-opening. It wasn't, I didn't have a big master plan. I want to be a banker for the rest of my life, but hey, I heard it was a good gig. And I was in it for about 4 or 5 years. But one of the cool things that I got to do in that was, one, understand how to evaluate risk and how to understand downside and underwrite things with real pro formas and math and that kind of thing I use every day now. But I also got to look at the personal financial statements and the tax returns of all the wealthiest borrowers of the bank.
Oh man,
and that was
you saw behind the kimono. You saw open the kimono. It wasn't like this man's a millionaire because he's got so much money in mutual funds.
He's got a big 401k.
What's that?
Yeah, big 401k. Look at
the size of his 401k. This man's a ginormous millionaire, right? No.
And the common denominator that I saw of the wealthiest were one of two things: either they own their own business, or they own a lot of real estate.
Yep.
Right. And so as I started seeing this pattern and saw the deals that they're doing, saw the net worths that they were growing, I was like, that's what I want to do.
Yep.
And so I at the same time, I had risen pretty quick in the bank to a level where the guys that were in the bank for 30, 40 years, they weren't doing much different than what I was doing. And I was like, I can't do the same thing for the next 30 years and, just get a golf on Friday and, have my life be determined by whatever the credit committee says. Right.
But you can really start living life at 65 then, you see.
Right.
You do all that. And then by the time you turn 65, you live for another 5 years, go watch waiting on you,
Hey, American dream, baby. American dream.
Yeah. Right.
So,
it was.
So
in the 80s
it was. Yeah. So I had some realizations, had the opportunity to jump over pretty early on, and the rest is history. So I'm never going back, and I'm having the time of my life.
Love it. You are primarily in the multifamily world, correct? With Aspen.
We do a little bit of a little bit of everything. No, we do a few different things. We actually started in distressed debt in mortgage notes back in 2013. Then we scaled up a lot in multifamily. And then we've since built out industrial development arm. So we have a large development arm. Okay. And then oil and gas, actually. So we've gotten a little outside of real estate and have been doing that for several years.
True diversified. You really did drink. You really do drink your own Kool-Aid, brother. Like a billionaire is not going to do just one thing, right? Or one asset class. What is your prediction on the asset class that's today 2025, right? That's underperforming now that you think is going to pop in the next 3 to 5 years?
Yeah, I think multifamily for the next 2 years will continue to be challenged. I think there's so much just stuff working through the system. We can get into all that with a of time, but I think 3 years from now, maybe 4 years, but probably 3 years, we're going to see a big tick up in rent growth again. And continue to have undersupply of housing. So I'm actually a believer in multifamily, but I don't buy anything that I don't want to hold for at least 5 years, because I think you have to have a longer term mindset to be able to benefit from the changing tides. In the shorter term, I'm very bullish on industrial. And this is an asset class that has done exceptionally well over the past decades because of the e-commerce boom. But I think we're actually headed into a industrial 2.0 boom that is being driven not only from e-commerce, which is still growing, but at a much slower rate, but reshoring trends, bringing manufacturing back to the U.S. This was happening well before Trump's big tariff policy and Make America Great Again ideology came into play, but it is accelerating it, and we're seeing massive shifts from companies that are bringing manufacturing back to the U.S. for a lot of reasons. One is to control the supply chain, have more control over it. Everyone got surprised during COVID with the supply chain issues. And two, it's actually not as expensive relatively to produce in the U.S. as it used to be in other countries. China's wages have increased 15x over the past 2 decades.
That's
1,500%. In other countries as very high as well. That's going to
continue. That's going to continue because China continues to emerge. And it doesn't take thousands and thousands of workers to make a microchip anymore.
No.
Or to make an iPhone. Right. There's no reason why we can't make iPhones and microchips in the U.S. because a lot of iPhones and microchips are made through robotics. Right. Yes. And I can put a robot in America or a robot in China. It's the same thing. Maybe an American operator is going to earn a little bit more living wage to run it. All good. But they're catching up a good bit. And maybe Americans are willing to pay a little bit more for that thing, and knowing that it was made in America. Right. Who knows? Or maybe we just find ways to make things more cost efficiently here. Let's not put too much on American pride that it's going to go to the wallet. I don't know.
I mean, I think there's an element of cost savings is one element.
Yes.
That's not always the biggest driver. I think the bigger driver is, to your point on microchips, it's actually control over the manufacturing of it and not being reliant on Taiwan or another country that some big epidemic happens again and you can't get the chips. And Ford auto manufacturer, as a great example, was sitting on at one point $5 billion of cars and trucks on lots they could not sell because they were missing the chip.
Yeah.
How much did the chip cost? Not that much relative to the rest of the car. Yeah. And if I have to pay 20% more for that chip, it's not going to increase the cost of the car.
Yeah. Ask the CEO of Ford Motor Company how much he would have paid for chips to get all those cars off his lot, right?
Yeah. So I think it's going to be more strategic on what things are manufactured. It's not going to be everything, but on critical components like that, absolutely, it's happening.
People also got shipping charge, right? How much does it cost to send a microchip in a sea container across the ocean? Yeah, I get it. It's economy of scale, so it's probably not a ton, but it's certainly cheaper to build that microchip one state over than it is to build it half a world away, right?
Right.
So I love it. Industrial. The world is changing, man. So Ben, this is the hour has flown by, my friend. You and I solved all the problems. We talked about longevity. We talked about financial planning, the death of financial planning in America, and how real estate investors are the new financial planners. I think you might have said that personally. I'll give you all the credit for that. Actually, Ben didn't say that. That's okay. But for those who want to hear more about Ben Fraser, Aspen Funds, and the Invest Like a Billionaire podcast, how do folks reach out to you to hear more about what you're up to?
Yeah, sure. We got our podcast. You can go to thebillionairepodcast.com. And we also you can pre-order the book right now at thebillionairebook.org. So those are
folks can go to thebillionairebook.org.
Yep.
And pre-order a copy of your book that drops in September, correct?
Yep, you got it.
Folks, let's do that. I'm gonna go grab my copy as well of that. I want you guys to all go and do that, because even though, best ever listeners, you don't want to be a billionaire, I get it. There's a lot of hassle. All of a sudden you got all the attention like Elon Musk and Jeff Bezos does and all that. That's a lot of attention. But let's all start thinking and investing like them so that we can grow our wealth faster. There's an old adage, Ben, observe the masses and do the opposite, right? So if the masses are investing to achieve one day millionaire status through growing a retirement account, maybe do something different and you'll grow even faster than the masses will.
Yeah, love it.
Ben, thank you for joining us on the Best Ever CRE show today.
Matt, so fun, man. It's really, really good time.
All right, talk to you soon. Guys, great conversation with Ben. I really enjoyed a lot of things we talked about. We touched it all, man. We talked about the longevity. We talked about what is financial freedom. A lot of great questions there. I love conversations where I get to really just riff and go in all kinds of different directions with somebody. So hope you guys enjoyed that too. make sure you guys come see me. Every Friday, my show, Next Level CRE, drops on Fridays. So come and see me next Friday and the Friday after that. Like I said before, make sure you subscribe to this show, put it into your subscription feed on your favorite podcast media source, and you guys can listen to us every day if you like to, because we're out there every day with new hosts, new conversations about building your real estate investing strategies on a daily basis. So come see us. Until then, have the best ever day.